Hello class, welcome to this chapter 8 video. This lecture video on chapter 8 where we're going to start talking about some short-term decision making. In chapter 7 we learned a little bit more cost terms, learned how to make some basic decisions and learned to calculate some numbers like some break-even point, how many units do we need to sell to reach a target income, stuff like that. We learned about the contribution margin and all those. If you got a good understanding of that, is going to make this next chapter make a lot more sense. So hopefully you have your chapter 8 handout ready. That's what we're going to go through. Let me get my slideshow going here. Get my screen shared with you and we'll get started. Basically, we're going to be talking about short run decision makings. It could also be known as operational decision making. Okay. Some books will call us differential analysis. So we are going to understand we're going to understand the decision-making process, and then we are going to look at several different types of decisions and be able to pull out the relevant costs and stuff like that. Okay. So what we're doing here is we're choosing between alternatives for a business. And what is every business looking to do? They want to make a profit. Okay, so there's an example they use here, accepting a special order for less than the normal selling price. Okay, should we take that special order on? We want to make a profit. Well, we have to look at some relevant costs there. Okay, and that's one of the decisions we're going to look at when we get into this chapter. Okay, so what's relevant here? What's cost? Should we accept this order? Should we deny this order? It's all about increasing our profits. Okay. So there's a six-step model. First, everything's still working good. The screen's just kind of a little funky. Okay, I think everything's good. All right, so kind of our 6 steps here. We're going to run through them real quick, and then we'll go back and we'll analyze them all just a little bit deeper, one at a time. So first, we recognize and define the problems. Step 2, we identify alternatives. It is reasonable or understandable that it is going to work. Okay, step 3, we identify the costs and benefits, also like the expenses and the revenues with each feasible alternative. Then define whether they're relevant or irrelevant. We're going to talk a little bit more about that in a little bit. And then step 4, we estimate the relevant cost and benefits for each feasible alternatives. So steps 3 and 4 are kind of the same. We identify and estimate them. Okay, what kind of costs are we going to have? Is it relevant or irrelevant? And then what's the amount going to be? Then we look at the qualitative factors, the stuff that aren't dealing with the numbers. Okay, something that's important in decision making. How's it going to affect our reputation? Are we breaking any laws? Okay, are we acting ethically? Things like that. Those are quality factors. And step 6, make the decision by selecting the best alternative with the greatest benefit. So recognize and define the problem. Okay. It seems pretty simple. Sometimes recognizing there is a problem in the real world is one of the hardest things. Okay. Do we need more workers? Do we need more space? Do we need to add more equipment? Do we need to add more additional sales floor space? Okay. Identifying the problem. Once you have identified the problem, so let's look at possible solutions then. Okay. What level of risk is, what kind of budget you're working with, okay. What kind of returns are you looking for with the investment that you're about ready to make? Okay. Just you're going to go through a brainstorming session here. So we identify these alternatives. The costs and benefits. At this point, irrelevant costs can be eliminated from consideration. This is where we get to talking about relevant and irrelevant costs. There's a slide on later. What we're talking about here, when we're talking about irrelevant costs, we're making 3 different products. We're making t-shirts, socks, and underwear. And the underwear segment is losing lots of money. The costs that are going into it, it's a really high fixed cost amount. So if we stop making that underwear line, but those fixed costs go away, fixed cost. Okay, so that's the, you know, the mortgage on the plant factory, then you got your depreciation on your equipment and your insurance and stuff like this. That's spread out to there. Some of that is not going away. Some of it might go away, but maybe not all of it. Okay, so we have to determine whether the cost is relevant in this decision. Okay, we're only going to include relevant costs in step number 4. Okay, this is where the term I said at the beginning, some people call it differential analysis. Step number 4 is kind of finding the differential cost, the differential revenues, the differential cost, the differential income. And differential is just what is the difference between choosing alternative 1 or choosing alternative 2. Okay, and only get those relevant costs in there. And then again, those factors, political pressure, breaking the laws, your reputation, things like that. What are people going to say about me on Twitter, on Facebook, if I do this, if my business does this? Okay. And then product safety is another important one. Maybe you can cut some costs, but maybe to make your product unsafe, which will end up hurting the company in the long run. Step 6 is always the last step in the decision-making process is to make a decision. For purposes of this class, when we're running stuff in homework and through our examples, what's going to provide the best benefit for us is always going to be what increases our net income the most. But of course, we have those qualitative factors that we just talked about in step 5. So maybe the greatest net income may not only be the best decision for business, but overall, what a business is looking to do is to make profits. Costs. Costs are relevant making decisions if they have those 2 characteristics listed there on your screen. They are in the future. They are going to happen now, immediately, or in the future, and they differ between alternatives. Alternative 1 is going to have one cost for this, and alternative 2 is going to have another cost for this. If they are the same, it's going to cost the same no matter what we do. That is what makes that cost irrelevant. The relevant cost can be left out of the decision-making process. Okay? So as long as relevant costs are happening in the future, today or and as long as they differ between the 2 or 3 things we're trying to choose between, that makes the cost relevant. Cost. You probably heard this in your economics class. Opportunity cost is the cost that is giving up when you choose one option over the other. Opportunity costs are always relevant because it's always something that's in the future, and it's always going to differ because by definition, it's the difference between one alternative or the other. So it's a second criteria that is going to differ no matter what you choose. Okay? There's a different type of cost is a sunk cost. Okay, sunk cost as something that has been paid in the past. It should never, ever, ever have any impact on our future decisions. And unfortunately, this is a case where it happens way, way too often. I like to use on a personal level, not even on a business level. Somebody went out, 16 years old, bought a car for $1,000, just an old beater. They put some new brakes in it, they overhauled it, put some new tires on it, painted it up real nice. Okay, they've had the car for 4 years. They probably put $5,000-$6,000 into it. Okay, and now all of a sudden everything starts running smoothly. The transmission goes out, and it's going to be another $3,000 to fix the transmission. So now you're looking at a decision of do you want to go buy a new car, or do you want to stick with the old car? If you're sticking with the old car, it's very easy to think about all the money that you put into it, okay, all the time and the effort, okay? That is the definition of a sunk cost. That should be really irrelevant. Emotions make sunk costs sometimes hard to overlook. That becomes into that call it action sometimes, but from a pure financial standpoint, some costs that happened in the past. Change them. So we should only look at the cost and the benefit moving forward. Okay? The cost of buildings, property, plant, and equipment, and its accumulated depreciation is the most common cost you're going to see in this class. And then we talked about cost behavior back in chapter 3. Okay, so having a good understanding of cost behavior, remember that variable costs increase with total production, but on a per unit level they stay the same, whereas fixed costs stay the same no matter what, but on a per unit level they decrease. So what kind of events are we going to look at? Okay, so here we're going to make a buying decision. Okay, do we want to make? We're a manufacturing company. Do we want to continue to make all these components? Maybe we're a medicine company. Do we want to continue to make the plastic bottles that we package our medicine in, or do we want to buy those bottles from somebody else? Okay, what's the best decision for us? Figure out this segment on a product line. Kind of use this example a little bit ago. Say we're a clothing company and we're making t-shirts, underwear, and socks, and the underwear is losing a lot of money. Should we drop that product line? Okay, you would think if it's losing money, yes, but sometimes that product line hiding some of those fixed costs. Except a special order at less than equal price, then what we start this whole chapter off with. And then the final one here is to process further or sell them at the split off point. So think about maybe we're in a dairy. We get here, we get to the point, and now we got milk. Should we sell right now, or is it more financially fiscally profitable, more profitable if we were to take some of this milk and process it further into yogurt? Okay. Many others of these. Okay, these are just some to get you an idea, to get you used to thinking as a manager, looking at these numbers, and having to make these decisions. Okay, so make a buy. Internal or external production. Here's an example. Lossy manufacturing needs to determine if it would be cheaper to make 10,000 in-house or purchase them from an outside supplier. Cost information includes the following. So we're going to go through here. What is relevant? Okay. Direct materials. That is relevant, right? Because if we continue to make them, we're going to pay in the future. And different for alternatives. If we make them, we are going to have the $10,000 direct material cost. Okay. Direct labor, yes. Yes, that's relevant. All costs are going to be relevant if we decide to make them. As far as the fixed overhead, that's going to be irrelevant because we're going to get that fixed cost whether we make them or buy them. That fixed cost is going to be there. On the buy side, we don't have to worry about we have zero material cost, zero labor cost, zero variable cost, but we do have a buying cost of $475 times the 10,000. Okay. We kind of listed the relevant costs. Labor, relevant cost of purchasing is the purchase price from a fixed overhead is the irrelevant cost in the situation. So differential analysis, this is what I do when this is going to be more helpful, honestly, for you on this chapter is to go through the handouts and work those problems and actually work these numbers and make these decisions and then watch me and see how I do it. But this is what I'm going to do. I'm going to draw it out here in 3 sections. I'm going to have make, buy, and then our differential. Okay? And actually, when I do this, you're going to see me if stuff is a negative, I am going to put a negative. I'm going to put my parentheses around it. Okay, but these are all costs. Okay? So, if we were to make them, we would have a total cost of what? $38,000. $10,000 in direct material, $20,000 in direct labor, $8,000 in direct overhead. Remember the overhead is irrelevant, so we're excluding it. If we were to buy it, we'd have to purchase 10,000 of them at $475 each, or $47,500. Okay, so as you can see here, our differential cost is going to cost us $9,500 more if we were to buy them. That's kind of how to read this chart. Okay. To make. So the differential column when you're reading it is if number 2 instead of number 1. Save $10,000 on direct materials. We will save $20,000 on direct labor. We will save $10,000 on variable overhead. We will pay $47,500 for the component externally, meaning it will cost us $9,500. It is cheaper to keep making it in-house, which is what we will keep doing. Here, we're throwing something new in there. Okay. Some of that overhead does not have to be paid. There's 44,000 there, but 10,000 of it is avoidable if we were to buy the product. That would be information we'd have to know. That would be given to us. It probably was given to us in the question up there. I overlooked it as part of number 4. We have to put that back in here. There's an additional $10,000 cost here. So now when we're looking at saving $10,000, $750. Now it is cheaper by $500 to purchase the component from an outside supplier, just based on the information that we're given. Okay, special orders. The main thing we're going to work on with special orders is, do we have the capacity to make this order without having to pay overtime, add to our direct labor costs, without having to buy new machines? We don't have to go out and do capital investments, right? Okay. Do we have the capacity currently without overworking in order to make it this product? Okay, that is kind of one of the first things we want to look at. Here we have a company to purchase 20,000 units of a certain model at a price of $89 each. Okay. Other customers. So what that means is it's not going to steal sales from another company. So existing sales will not be affected. 100,000 units per year. Plan to produce 75,000 for the iPhone. That means that we get 25,000 more. So if they want to purchase 20,000 units, 75, but we're capable of producing 100,000. We have the capacity. Normal sales price is $14 per unit. So here we're breaking down that cost. So we're going to sell it for 40. I'm just trying to get, sorry. While they're trying to buy it for $89 each, when the normal selling price is $14 per unit. Of course, you're going to sell them $75 profit, higher than your normal selling price. Okay, but anyway, I'm thinking maybe there might be a typo, like there has been so many other sides. Let's keep looking on here. So here is the cost to produce this. Okay. It says fixed overhead will not be affected by the special order. Second, what are the relevant costs and benefits of the alternatives? Okay. Well, if we reject this offer, what is going to happen? Nothing. Okay. Costs aren't going to change. Okay. But if we accept this order, cost, they're going to have more direct labor costs, they're going to have more variable costs, but the fixed overhead is not going to change. It's going to stay the same. Okay, so that's not $89. It's supposed to be $9. So here we go. So I would do the same way here. I write out my two things in my two columns. The three columns: accept, reject, or differential. I would probably even put reject first because reject is 0. Okay, so we're looking here. If they're going to pay us $9, well, for each one we make, we have the capacity to make it. It's going to cost us all the variable costs, but we can ignore the fixed costs because if we say no, those are still going to be there. All right. Change, it's irrelevant. So we make $1.70 for each one that we sold. So if we wanted to buy how many of them? 20,000, $1.70 times 20,000 units. We would increase our income by $34,000. So we want to accept that special order. Keep it drop. This is another one. Segments that maybe losing money, and sometimes you might think, yes, it's losing money, let's get rid of it. But again, start looking at relevant costs. We're going to look here, fixed cost again here. That's the big thing in most of these. Cost because sometimes segments that are losing money, some of that fixed cost is allocated to them, through that overhead process that we did back in the first units. Okay. So taking a big chunk of some of the plant-wide overhead on that segment, causing it to lose money, whereas if we cut that segment out, we do not lose those costs. It just gets spread out to other places, and we lose, and we lose money overall. A lot of my train of thought there because something else popped in my head. So what is the big number we're kind of looking for here? We're going to do that whole differential analysis, but if you just kind of want to make a quick look at this, think about contribution margin, right? If your segment has a good contribution margin, but it's not covering all fixed costs in the multi-product company, it's probably still a pretty good segment, okay? Just because some of those fixed costs are company-wide, and it's helping keep those down and making the other products more profitable. What I'm talking about here, you have direct fixed expenses and common fixed expenses. Direct go directly to that product segment. Common are factory-wide, and they're not going away. The common fixed expenses are irrelevant, while direct fixed expenses are relevant. Okay, they're directly traceable. That's what makes them relevant. Common fixed expenses are irrelevant because they're shared by more segments. We cancel one, we just move to another one. So here we have sales, cost of goods sold, okay, and direct fixed overhead. So all these are traceable. So what do we got here? 400, 200, minus 230, 170,000, and 160,000. Transformation is paid for each of the products line. And it gives us some selling and administrative, and then some common overhead. And some common. Prepare a segmented income statement for Automatronics for the coming year using variable costing. So we're going to list it out here, and it wants to know, how is each segment doing on its own? You can see here our MP3 players got their sales. It has variable cost of goods sold, variable selling expenses to get to its contribution and margin. Then you subtract out the direct fixed expenses, okay, to see that the MP3 players are making 140,000. Smartphones are making 90,000. Okay, so we're making 230,500 before any of the common costs come out. Okay, so you have to look at them like this, and when we're making decisions on what we want to do with this, we're only looking at kind of these inside lines. We don't want to worry about, we're going to see how changing this ends up changing this. So here it is in our example. We have a segmented income statement. Most of your examples, you're not going to have to create one. They're going to be given to you here. And as you can see, the tile is losing $45,000. So we want to know what would happen if we got rid of it. So what are the alternatives? Keep the roofing tile line or drop it. The relevant benefits and costs include sales, variable cost, advertising, and supervision costs, right? Says depreciation, but depreciation is not direct. Depreciation is indirect. Okay, because it's not even indirect. It is a sunk cost, right? It's going to be irrelevant. Cost of old machinery and the depreciation accumulated on that is always irrelevant to our decision making. So when we're thinking about getting rid of the tile, we're going to lose the sales revenue. We're going to save that expense. We're going to save that expense. We're going to save that expense, and that one is irrelevant. So we were to keep the segment here, we would still lose $35,000. So in this case, drop the segment. Finally, joint products. Joint products is, like I said before, maybe milk, and then you're going to make it into butter. But you come to a split off point where we can either sell it now or we can process it further. So here we have an example of that. We grow apples. We have A, B, or C apples based on their condition. The grade B apples can be sold, or we can make them into apple pie filling. We sell the grade B apples $1.25 in 125-pound bags at a unit price of $1.25. Right, so if we were to sell the apples, it says first, what is the revenue? $1.25. We sold 120 bags of 5-pound bags at $1.25 each, $150. If we were to process them further, we would get 500 cans of filling, an additional cost of 24 cents a can, and the buyer will pay 90 cents a can. So what is the contribution to income if we process further? So we have 90 cents a can times the 500 cans is 450. But we need to subtract out how much it would cost for further processing, okay? Be 24 cents a can times 500 equals 120. Okay, so it's going to cost us $120 to process it further. But our sales are going to be 450. 450 minus 120 equals 330. So if we process it all the way out, we are going to make profit of 330. If we were to sell it now, we'd make profit of 150. And that's what we would want to do. Okay, one of the ones I did not talk about at the very beginning when I was previewing this was product mix decisions. Okay. How do you want to make, how much of each product do you want to make? We're making product A and B. Okay, and product A takes 2 hours on the machine, product B takes 4 hours. We have enough demand, more demand for both products combined than we could possibly make. Which do we make more of, product A or product B? Okay, that is a product mix decision. Okay, that is a constraint is the number of machine hours, or maybe the number of labor hours, or maybe just the number of hours in a day. You know, you can only make so much, but how do you choose what to make? So we produce two types of gears, X and Y. X has a contribution margin of 25. Y has a contribution margin of 10. Each gear must be done by a special machine. We only have 40,000 hours of gear time. Gear X needs 2 hours and gear Y requires a half an hour. Whenever we're doing this, what we want to do is we're going to find, we know the contribution margin per unit, but since they're both using this piece of equipment and that is our constraint, we want to find the contribution margin per the restraint. So in this case, it's going to be machine hours. And whichever one has the higher contribution margin per the machine hour, that is the one we're gonna wanna do. So how do you find the contribution margin per machine hour? Well, you take the contribution margin per unit and divide it by however how much time is needed on the machine. It could be labor hours, could be, or whatever our constraint is here, is machine time is our constraint this time, could be labor hours, could be whatever it is, but it's the required machine time per unit. Okay, so here you can see, we take our gear divided by only a half an hour, we get a $20 per hour contribution margin for gear Y and $12.50 per hour contribution margin for gear X. So we want to make as many of gear Y as we can sell before we start making gear X, even though it has a higher contribution margin per unit. Okay, and that just means we're going to be able to produce the most of them that way, along with the contribution margin per unit, reach a higher total net income. Okay. Okay, so yeah, here it's not saying, it's saying if we could sell if we could sell as many as we could make, we would use it all on gear Y and not make any of gear X. It would make us the highest profit, but you know, that's assuming that we can sell everything we can make. So here's another example, okay? It's the same one. So here we're gonna make all that gear Y, that's what I was saying, okay? Gear, there's only 60,000 units that are in demand. So if we're gonna make gear Y first, we'll make as many as we can. So we'll have 30,000 hours needed. Meaning we'll still have 10,000 hours left to make gear X. So if it takes 2 hours to make gear X, we can still make 5,000 units of gear X. Okay, just depends on what that is. All right, last couple things we're gonna talk about is not about making decisions. It is about making decisions, but it's not about lowering costs. It's about what you're gonna set your prices at. Okay, first is cost-based pricing. This is where you look at your cost of your product, and then you decide what you're going to mark it up, and you calculate that percentage and you mark it up. So say it cost us, we're going to say we want to mark it up 10% over cost. It cost us $70 to make, so we're going to sell it for $77. Okay, the $70 plus 10% of $70. Okay, that is cost-based pricing. So here's an example of this. We had simple install computers. So it's going to price its jobs at the cost of direct materials and direct labor plus 20%. So here the direct materials were 6,500. The direct labor was 4,000, so a total of 69,000. So they're going to charge it at 69,000 plus 20%. That's going to be the cost of the job. Okay. They show you to do 69,000 plus 20% times 69,000. You could also get this exact same number, shortcut, okay? 69,000 multiplied by a 120% or 1.2. Okay, there's a shortcut there that'll get you that exact same answer. And then finally, there's target costing and pricing. This is where you set your price first. You say, this is what the market says. Let's make our cost get below it. Let's set a target cost. Okay, this can be a lot riskier because it causes people to cut corners. Could be unsafe, could not have the proper components and all that stuff. A lot of risk here. But in highly competitive markets, this is what you have to do because supply and demand, that's going to set what the price is. So you need to make sure your cost is below that. Okay, so how to calculate this target cost? So here comes a watch. We want to know that the markets right now, we're going to be able to sell this watch for $200. We want a 15% profit. So how much could that watch cost? Okay, so if we want a 15% profit, 200 times 15% means we need a $30 profit. So if we're selling it for 200 and we need a $30 profit, our target cost, we need to get our cost at $170. Okay, that's it for the chapter 8 slides. Hopefully that was helpful. Like I said, I think it's going to be more helpful when you're watching the videos on the handouts for this chapter, okay? Because we're making decisions. So we're really looking at what is relevant and what is irrelevant and applying those costs in to decide what we should do. So keep an eye out for those videos. And as always, reach out to me if you have any questions. Talk to you again soon.